What's up, babies? Back again, another amazing summer weekend. Sun's been out, been at the beach, getting a little tan. All right, so for this educational video, we are going to review a few things, very important. There is a reason why the market keeps plugging higher over and over and over again. It has to do with the multitude of macroeconomics. It has to do with politics. It has to do with the central bank. It has to do with the option chain, et cetera, et cetera. The previous video talked about the option chain, dealer delta hedging, and that moving the market up on top of the VIX being shorted. This current video is going to talk about what I like to call never-ending liquidity supply. Okay, and this has come in the form of the BTFP, both Powell and Yellen plugging all the regional bank issues, SVB. The current and forward EPS earnings for the market. We're talking about the Mag 7, what they're currently looking at, what they're currently projecting 6 months out, 12 months out, etc. Government spending, which trickles into the market as well. And most importantly, the yen carry trade. Okay. This video is for educational purposes only. If you guys have any questions, you let me know in the comment section. If you want to join the Discord, we will be opening up again soon. Ping me on Twitter. Get it done. Talk to you guys soon. Now, this part is arguably the most important out of all the points we're going to make because of all the excess liquidity that came in through various sources that wasn't quantitative easing, while institutional buying demand has remained below average on the entire run. It is because of this that the S&P is able to plow higher month after month for an entire exaggerated year. Okay, so let's go over each one, talking about what they are, how they work, and how they're affecting the market in full. So I'm going to take you guys through this list. We're going to talk about the BTFP, Powell and Yellen intervening with the regional banking crisis, forward EPS from the Mag 7 leading to aggressive options buying, which we just talked about, government spending, which has to do with the repurchase markets, and the yen carry trade, which added a ton of excess liquid money into United States Treasuries and United States equities. The Bank Term Funding Program. This was issued in March 2023 and it ended in March 2024. The BTFP is a vehicle that allowed institutions to have overnight liquidity grabs if they were in some type of emergency crisis. Okay, you can see how it started here, and the BTFP rose in liquidity, and on the left side you're seeing on your Fred chart, it's 160,000 millions, which is $160 billion, okay? During periods of quantitative easing, the Fed is buying assets, pumping cash into the system. Domestically, during periods of quantitative tightening, they're doing the complete opposite. They're taking cash out and they're pushing those US Treasuries, mortgage-backed securities, bonds of various maturities, etc., back into the system. So supply up, yields up. But what that means is that liquidity comes out. So during this period of the BTFP, QE stopped. So they basically came up with another vehicle to continue to add money into the system. And this is what the BTFP was really not only created, but abused for during the period in time from inception of its life cycle. To give you guys some numbers, from 2020 to 2021, QE added $2.6 trillion in bank reserves. From 2022 in June when QT began to 2023 when QT ended, 0.6 trillion was taken out of bank reserves. So 2.6 trillion in with the BTFP on top of that, still adding more cash and liquidity, 0.6 trillion out. It's because of vehicles like the BTFP holding the market up, allowing banks to continue to do their overnight repurchase market liquidity requirements and continue to keep money flowing through the equity system. Remember, one important thing with the BTFP, it basically allows institutions to come to the Fed with collateral that might be valued under par and have it valued at face value and get the same amount of cash overnight for that collateral that's not as worth as much. If you were to go to something like the discount window, you would only receive the specific amount of liquidity for overnight based off what your collateral is worth in the market currently. So based on its current market value, not at par value. So if you think about it, the BTFP was kind of like a cheat sheet to get more money than you probably deserve to have in the first place because your assets are not worth as much. Outfit change. So the regional banking sector is one of the most important banking sectors in the entire financial industry. Powell and Yellen have been intervening, plugging these regional banks with targeted liquidity injections when things have gone wrong for them specifically. So with regional banks, you have to understand they are much smaller than the GSIB banks. The GSIB banks, JP Morgan, Morgan Stanley, Goldman, B of A, Citi, they are over 500 billion in assets. The regional banks are less than 500 billion in assets. And they serve, they have different business profiles, risk profiles. They serve specific regions within specific states, et cetera, et cetera. So the most recent issues that have gone on within the regional banking sector have been Silicon Valley Bank, Signature Bank, and First Republic. Now, these three banks collapsed. The biggest one and the most important was Silicon Valley Bank, and they were over leveraged in their fixed income investment portfolio. The bond market has been shorted by hedge funds since the COVID drop, okay? When the COVID drop happens, equities drop, bond prices spiked, bond yields down. But when bond prices spiked, hedge funds took out a $700 billion plus short on the bond market. They have been pushing it into the dirt ever since COVID. It's gone on for years. Look at Bill Ackman's trade and what he did with the bond sector. It's one of the most phenomenal trades in financial market history. So Silicon Valley Bank was super over leveraged. They had incredible unrealized losses in their fixed income department, and they doubled down on it and just got absolutely their butts handed to them. On top of that, they invested in a lot of crypto, and a lot of that crypto money needed to be under control of new, larger financial institutions. So the Fed not full-scale bailed them out, but put in policies with the government in place to make sure that those three collapsing didn't collapse the entire financial system, okay? So the regional banking sector is so important because they have 70 to 80% of all the commercial real estate debt currently in the market. You're talking something like, and I just had to look it up because it was such a crazy amount. I remember reading about it last year. But right now, their unrealized losses and exposure is 3.6 trillion CRE loans. That is absurd. And those loans come due to be refinanced in 2026 or 2025. So things are going to get rocky very, very soon. And that's one of the reasons why Powell and Yellen have been keeping these things afloat. Their BTF list, they can put specific banks on that list to give them liquid injections when they need, just in case something goes wrong, okay? Just remember, the entire purpose of monopolizing the entire banking sector has to do with consolidating the regional banks with the GSIBs, et cetera, et cetera. You are going to see these regional banks, a lot of them, and a lot of these smaller banks, tier 2, tier 3, et cetera, fail in the coming 2 years. And when they do, the larger GSIB banks are going to scoop them up, and they're going to have full control from the top down. This is what they've wanted for the last 20, 30 years. They've been planning it for quite some time, and we are getting to that period where things are going to start being put into place, and you're going to see the rule changes, the regulations, compliance, et cetera, et cetera. You're going to see all these other mid-sized banks being bought up by the larger banks, and it will come in a very fast and swift measure as the economy tanks going into 2027. My Giants are terrible this year, as to be expected. Just chatted with Tommy DeVito in the parking lot of my old building, and nothing changed. Next up, forward EPS from the Mag 7 being priced into our current market trends. Now, remember, the market is always forward looking. When news and events and earnings, etc., come out, the market prices that in immediately, and the price changes happen in our current time window and our local price action on whichever chart you are analyzing. Currently, one of the most powerful narratives in the market is that earnings have been stellar across the entire S&P 500. This has not been 100% true because the Mag 7 and maybe 3 more stocks are currently carrying the other 490 stocks in the S&P 500. Now, this monopolizing of the entire growth sector between Amazon, Tesla, Nvidia, Google, Meta, Microsoft, and Apple, okay, has allowed CNBC, Fox, CNN, etc., to say that there has been elevated GDP, earnings are strong, forward EPS is strong, which is a calculation of the future, quarter, 12 months, etc., based off current earnings, where these companies' streams of revenue, their cash, their dividends, etc. There's a whole laundry list of things that go on all these earnings calls that are analyzed every single time one of these Mag 7 stocks has an earnings date. And that is why corporate earnings drives the S&P, okay? Corporate earnings will always be the underlying driver of expansion in the American economy. It is so incredibly important that your risk assets, equity, is outperforming your value assets if you want to grow an economy. However, that does spur inflation. Growth always spurs inflation, but you want it to be controllable and manageable inflation that the Fed does not have to intervene at these moments. Now, quick data here. On top of the Mag 7, if you broaden out a little bit to the most important retail consumer stocks like Costco or Nike, et cetera, these stocks are beating not only quarterly revenues compared to the previous fiscal year, but they're also beating on their earnings per share. So this has come in so consistently over Q1 and Q2. Now we're entering Q3 earnings coming into the end of October, beginning of November. But the projections and expectations are through the roof. We are talking 26.8% year-over-year growth for Q2 among the Mag 7 stocks. That is what is carrying GDP and allowing it and all the news outlets to say that the economy is consistently growing. When you monopolize the economy into 7 to 10 stocks and they carry 27% of the market cap weight of the entire country, it's not hard to manipulate those earnings, to make sure that we are showing consistent growth. Okay, that is where the big money from institutions is going. Pension funds, asset managers, insurance firms, etc. They're all piling in to the companies that are going to reward them with the highest year-on-year returns. Okay, so the big picture here is pretty simple. If the majority of the market cap weight of the S&P 500, regardless what the other 490 is doing incredibly well and growing consistently with a year out forward EPS projection of growth of 15-25%, there is no narrative reason for the S&P to stop rising month after month. Next up, government spending. Now, government spending has been uncapped until January 2025. That is when policymakers, politicians have to come together and they have to figure out how to extend this period so the government can continue to load up debt from the Treasury with newly issued Treasury government bonds and exchange those bonds with institutions in order to gain cash to continue spending to that period in time. Now, government jobs are the most important thing because that is what is controlling the entire basis and fundamentals of the American economy. Cops, firefighters, teachers, etc. Government jobs are what are also fueling these seemingly unbeatable and consistently rising non-farm payroll reports that we're seeing every single month. The expansion of government money and government jobs means the expansion of money that is flowing into the economy, keeping the S&P up. Now, this is how it usually works with institutions that have money market mutual funds that want to invest and get a fixed income return on their money markets so they can appease their investors, whether they be other institutions or retail. You're a retail guy, you have $10 million, you park it in a money market mutual fund. That institution takes your money from the money market mutual fund, parks it with the Fed in the repurchase agreements or the repo markets. The repo markets overnight. This is called a reverse repo, where you give liquidity to the Fed gives you collateral in exchange, and as long as you hold on to that collateral for an extended period of time, the Fed will continue to pay you a fixed income, high interest rate, depending on what the repurchase markets rate, the repo rate is at that moment. It's been around 5%. Okay, during this whole period in COVID. And while we are moving into recessionary indicators, a lot of people are getting scared, a lot of cash on the sidelines, most cash on the sidelines in history right now. You're talking in the trillions of dollars, is waiting to come in and is currently being parked in money market mutual funds. Now with government spending, okay, Powell has been raising interest rates 11 times and then he paused for a year. This has risen the 6-month government treasury bill to 6%. Now let's pull up this chart and you guys can see since the COVID low and since interest rates have been climbing all the way since mid-2021, the government T-bill is all the way up to, and I want you to think of this like you're an institution, 6.173%. Now if the repo rate is 5.5%, as an institution, you are going to want to diversify your portfolio. You are going to take some of your money, invest it with the Fed because it's guaranteed by the government and it's generally risk-free, right? But you can also take your money and invest it with the government in their new T-bills that are being issued by the Treasury at a 6.1% yield. Why would you not do that? okay? So that is why money is being drained from the repurchase agreements markets, right? And money market mutual funds, and being ejected into the economy, allowing the S&P to continuously rise month after month. This is extremely important to know because liquidity is what governs our market movements. We just talked about never-ending liquidity with the BTFP and Powell and Yellen intervening with regional banks. This is another reason why the market is consistently moving higher. Money being pulled out of the repo markets, going right into the economy, pushing the S&P higher every single week. Okay, lastly, for this part of the never-ending liquidity, and most importantly, is the yen carry trade, okay? This is something you guys have probably heard about in the media a lot, but this is something that has gone on for 30 years now. And it all started back in the early 1990s when Japan was having a housing crisis, similar to the one that we had in 2008, in which they had to lower interest rates to zero to stimulate their economy again and get people, get institutions lending and other institutions borrowing, retail borrowing, because at that moment in time, interest rates were too high, mortgage rates were too high, the housing had a constriction, and it completely collapsed. So this is the dollar-yen chart. Now, one thing about the dollar-yen chart you have to understand, because currencies can be confusing for people because they're talked in inverse and opposite, because you're comparing one country's currency against another. In this instance, we're comparing the United States dollar against the Japanese yen, okay? BOJ and UEDA, they control their central bank, and whatever goes on with the Japanese yen, how much money they're printing, how much interest rates they're doing, everything that you see with the Fed here with Jerome Powell, you're going to see in Japan, similarly doing the same things, but these currencies are compared against one another at any given moment in time, okay? Okay, so remember, as we go through this exercise in video, you are looking at the dollar-yen chart, which values the strength of the dollar against the Japanese yen. So every single time you see price action move upward, like here, the strength of the dollar is rising to this specific level, and the Japanese yen is declining contrarily, okay? Keep that in mind. You're not going to see it on the chart, but just understand, as this point, and we move to the next part, the strength of the dollar is declining. Conversely, the strength of the yen is rising against it, okay? Keep focused on that as we go through this. It can be a little confusing, just do your best. So the yen carry trade started in 1995, and this is coming after their housing crisis, and this is this low point in the chart, on the dollar-yen chart that you can see. Now what this means, because this is the dollar against the yen on this chart, this means that the United States dollar is valued down to this 80 level against the Japanese yen, okay? The Japanese yen is incredibly strong here. This is when interest rates were too high. The Bank of Japan lowered interest rates to virtually zero, stimulate lending and borrowing, okay? And that's why you see this spike off the bottom, because the Japanese yen is losing its strength now, okay? Lower interest rates, lower yields, lower strength of your country's dollar. If Japan's country's dollar is being devalued, the United States dollar value is rising against it. You can see it's moved around a lot here, and the next time it bottomed out was in 2008 when we had our housing crisis, okay? So the value of our dollar now is virtually much lower against the Japanese yen because we had to lower rates to near zero in order to stimulate lending and borrowing, okay? So when you see this point, remember, Japan's currency is stronger when it's lower on the dollar-yen chart. Japan is stronger. The United States dollar is weaker. Now, quantitative easing started with Japan in 2001. This was basically coming off the fact that lowering interest rates was not getting the job done enough. So they started printing money at that moment in time to a mid-level, not super aggressive point, but to a point where they were doing it enough that institutions were starting to borrow their currency because it was at a now lower interest rate. Remember, Japan lowered their interest rates to near zero. They're taking loans of the Japanese yen. They're investing that money in a higher yielding product like United States equities or US treasuries of various kinds, various maturities. This encourages other institutions globally and domestically to invest in Japan's economy and bring more business into the country, helping out, their currency and their corporations, et cetera, et cetera. The problem with QE is while it works in the short term, it also devalues your currency because you're printing more of it. The more of a currency that you print, the more the supply gets diluted, okay? The less strong it is. You have to eventually raise interest rates in order to get rid of some of that debt, have institutions and corporations start to pay off, but that constricts the economy. While it makes your dollar stronger, it will make your risk assets like your equities and your stock market devalued and decline, okay? So we get to this period in 2008, the US dollar lowers interest rates, the Japanese yen is extremely strong against us, but they are now starting to ramp up their QE aggressively. So the strength, and this is so crazy, because this chart breaks out completely here in accumulation phase D and E. The strength of the United States dollar, okay, as Japan is printing and printing and printing, starts rising against the yen. So when we get to this period in time, the United States dollar is strong and the yen is much, much weaker. The weaker the yen, the lower the rate that you have to pay, interest rate, to a bank, okay, to take out a loan to invest that yen and money into a higher yielding asset or product. And this is all fixed income. So just think if you're a pension fund, an insurance firm, asset manager, why would you not want to arb between the spread of those two yield prices? Like you're taking out a loan at 3%, but you're getting a 5% yield. You make 2% guaranteed over whatever the maturity of that fixed income is. As long, and here's the catch, as long as the yen stays devalued at that lower rate. Because when you take out a bank loan, that's not fixed. It's adjustable. So if the yen starts growing in strength compared to the United States dollar and the chart starts going like this, you as institution A have to now pay higher interest on your loan. Okay, it's adjustable. It moves with the strength of the yen currency. So that is your worst case scenario. This carry trade will only work for so long, right? But eventually if it gets unwound and you see the dollar yen do something like this, all of these loans that were taken out in this entire period in time at these low interest rates on the Japanese yen have to be unwound. You now have to pay back the bank for the loans that you took out because the strength of the Japanese yen is rising as the strength of the dollar is weakening against it, okay? This is the dollar and this is the strength of the yen going like this. Okay, it's not on the chart, but you have to visualize it. Dollar down, yen up, okay? This is easily, I would say, the most important thing that is going on right now that is being talked about the least. The yen carry trade is so important because it is one of the reasons why this infinite amount of liquidity keeps hitting the S&P. If something happens in the Middle East with war, Ukraine, Russia, Israel, Palestine, and war ensues, full-blown war, the price of oil is going to spike. Japan has to keep its economy solvent. Okay, so while they are devaluing the strength of their own currency, they can only do that for so long until inflation is going to eat their economy alive and their consumers, their retail, their citizens won't even be able to pay for groceries. So eventually this trade will be unwound, and when it does, it will be extremely violent because there are multiple trillions of dollars, I'm talking 20 trillion plus, invested in this carry trade on top of the government of Japan itself. The government of Japan itself is borrowing Japanese yen, printing it and borrowing it and investing it into United States treasuries and the United States stock market. So this is an absolute recipe for cataclysmic disaster.